This video is going to illustrate the use of the Black-Scholes model to find an implied volatility for a market-traded option. So on this tab, we have some market-traded options for SPY, which is an index mutual fund that follows the S&P 500. So on the left side here, we have options we have call options, and on the right side we have put options, and there are typically call and put options with similar strike prices that are priced here. And these prices were obtained from the options tab by searching for SPY on Yahoo Finance. On the second tab, we have all of the stock returns that were obtained by using Python to access Yahoo Finance. And these were obtained on September 28th. And they go back 5 years. And at the bottom here, the parameters for geometric Brownian motion, mu and sigma, are calculated. So we're going to enter these in the Black-Scholes model in the Black-Scholes tab. So we've got 0.1138 as mu hat, and then we've got 0.2092 as sigma hat, and we'll enter that for the volatility. The mu hat doesn't actually go on this Black-Scholes tab. Now, at the time these options prices were downloaded, the current traded price for the SPY mutual fund was $363.38. That was just noted by going on to Yahoo Finance right at the time those option prices were obtained. Now, we'll pick one of the options that has a strike price that's relatively close to the current price. And so if we go down, the current price is about $360. So we'll pick $380 as a price that's a little bit higher than the current price, but relatively similar. You could pick another one as well. So we'll use an option with a strike price of $380. Okay, now these particular options have expiration dates of March 17th, 2023. So one way to go out and get the time to expiration is just to Google the number of days between, say, September 28th and March 17th. And so we could do that here. And it looks like it's about 170 days. Okay, so we'll equal for the duration, or the time to expiration of this option, 170 divided by 365. For the risk-free interest rate, this option is about 6 months, about 0.5 years. So what we'll use for the risk-free interest rate is the 6-month U.S. Treasury bill rate. And we can just look that up here. 6-month U.S. Treasury bill rate. And right at this current time, it's about 3.83%. So we've got all the elements here to calculate the Black-Scholes price for this call option. And looks like it's $16.38. Now, if we look at the options prices and scroll down to the strike price of $380, the market price for this option is $20.18. So it's pretty clear that the market is pricing in more volatility than this Black-Scholes model. All of these parameters should be very close to the actual parameters, but what's somewhat in question is this volatility. It may be that the market's pricing in volatility for a shorter historical period of time than 5 years. So what we can do is we could determine the implied volatility. And goal seek is one way to do that. And so if we go to data and then what if analysis and goal seek, we can set this option price sell to the amount of the market price, 2018, we'll type that in, and then the cell that will change will be the volatility. And so it's going to change the volatility until the market price is produced in the model. And so it looks like the implied volatility right now for this option is about 24.78. That's what the market is pricing in. And the value of doing this is that we ought to be able to move forward and use this volatility to price other option strategies.